Forex trading is the simultaneous buying of one currency and selling another. Currencies are traded through a broker or dealer and are traded in pairs. For example, the euro and the US dollar, your/USD, or the British pound and the Japanese yen, GBP/JPY. When you trade in the Forex market, you buy or sell in currency pairs. Imagine each currency pair constantly in a tug of war with each currency on its own side of the rope. Exchange rates fluctuate based on which currency is stronger at the moment. Major currency pairs. The currency pairs listed below are considered the majors. These pairs all contain the US dollar, USD, on one side, and are the most frequently traded. The majors are the most liquid and widely traded currency pairs in the world. Major cross-currency pairs or minor currency pairs. Currency pairs that don't contain the US dollar, USD, are known as cross-currency pairs, or simply as the crosses. Major crosses are also known as minors. The most actively traded crosses are derived from the three major non-USD currencies, EUR, JPY, and GBP. Euro crosses. No. Exotic pairs are not exotic belly dancers who happen to be twins. Exotic currency pairs are made up of one major currency paired with the currency of an emerging economy, such as Brazil, Mexico, Chile, Turkey, or Hungary. The chart below contains a few examples of exotic currency pairs. Wanna take a shot at guessing what those other currency symbols stand for? Depending on your Forex broker, you may see the following exotic currency pairs, so it's good to know what they are. Keep in mind that these pairs aren't as heavily traded as the majors or crosses, so the transaction costs associated with trading these pairs are usually bigger. It's not unusual to see spreads that are 2 or 3 times bigger than that of your /USD or USD/JPY. So if you want to trade exotic currency pairs, remember to factor this in your decision. G10 currencies. The G10 currencies are 10 of the most heavily traded currencies in the world, which are also 10 of the world's most liquid currencies. Traders regularly buy and sell them in an open market with minimal impact on their own international exchange rates. The Scandinavia is a subregion in Northern Europe, with strong historical, cultural, and linguistic ties. The term Scandinavia in local usage covers the three kingdoms of Denmark, Norway, and Sweden. Together, their currencies are known as the Skandas. Back in the day, Denmark and Sweden established the Scandinavian Monetary Union to merge their currencies to a gold standard. Norway joined later. This meant that these countries now had one currency with the same monetary value, with the exception that each of these countries minted their own coins. But then World War I happened, and the gold standard was abandoned, and the Scandinavian Monetary Union disbanded. These countries decided to keep the currency, even if the values were separate from one another, and this remains the state of things. If you notice their currency names, they all look similar. That's because the word krona or krona literally means crown, and the differences in spelling of the name represent the differences between the North Germanic languages. Crown currencies. What a cool name, huh? I don't know about you, but saying hook me up with some crowns yo sounds way cooler than hook me up with some dollars yo. C currencies. C stands for Central and Eastern Europe. Central and Eastern Europe is a term encompassing the countries in Central Europe, the Baltics, Eastern Europe, and Southeast Europe, the Balkans, usually meaning former communist states from the Eastern Bloc, Warsaw Pact, in Europe. Central and Eastern European countries, CEECs, is an OECD term for the group of countries comprising Albania, Bulgaria, Croatia, the Czech Republic, Hungary, Poland, Romania, the Slovak Republic, Slovenia, and the 3 Baltic states, Estonia, Latvia, and Lithuania. Regarding the FX market, there are 4 main C currencies to be aware of.